Hello and welcome to ETBFSI.com. My name is Amol Dethe and you're watching the fourth and the last episode of the Union Budget Expectation series that we are holding on the ETBFSI.com, which is part of the economictimes.com. As the run up to the budget, we are carrying this series, and in the last three episodes, we have spoken to the BFSI leaders, the change makers, and tried to decode what are their expectations. In the final episode, also, we are going to speak with the change makers from the variety of segments: a banker, NBFC segment player, then the economist, and the insurance player we will have. And we'll try to understand their expectations from the finance minister who's going to deliver a budget on the 1st of February. Friends, as we understand, India is a growing country. In fact, it's a bright spot and great indicators. I mean, if you look at all the top frequency economic frequency indicators are absolutely in a great position. But while we talk about the India story, there are a couple of challenges as well, such as GDP ratio is very high. I mean, specifically debt to GDP ratio is very high. The government perhaps will have to keep a strong focus on fiscal deficit, and more importantly, the job creation, FDI, such issues are still needs more attention from the government. Uh, while we look at these major changes and challenges, let's understand from the four top speakers that we have for this particular session in terms of what are they expecting from the government and what is it that they think that the government should do specifically for the coming year. So friends, let me introduce you to my speakers. My first speaker for this particular session is Abhik Barua, Chief Economist of HDFC Bank. Abhik, glad to have you.
Sure. Pleasure.
My next speaker is Manish Shah, MD and CEO, Godrej Capital. Manish, glad to have you.
Thanks for having me, Amol.
My next speaker is Mr. Krishnan Subramanian, MD and CEO, Tamil Nadu Mercantile Bank. Krishnan, sir, glad to have you. And my next speaker is Mr. Tarun Chuk from the insurance side. He's the MD and CEO of Bajaj Alliance Life Insurance. Tarun, sir, glad to have you.
Yeah, hi. I'm all good to see you again.
Thank you. So, gentlemen, I have a few common questions and few specific questions as well. But let me begin by asking you a very simple common question to all of you. What is it that you expect from the finance minister on 1st of February? What are your expectations? What is your checklist? And Abhik sir, I will start with you.
Well, I'd just like to remind you that this is the interim budget, and the full budget will be announced in July. And there are certain sort of restrictions, barriers, etc., that the government has in announcing too many major policies in this budget. It doesn't mean so. Basically, this works as a sort of a temporary budget for the next few months till the new budget and the new government is in place. So I think we need to bear that in mind, and perhaps we shouldn't sort of run away with our expectations and hopes for the interim budget and save it for July. But I think certainly the finance minister will have to spell out a broader, fiscal roadmap, a broader set of priorities. And again, since I'm an economist, I'm going to drone on about the fact that fiscal consolidation needs to be key. And I think with revenue growth from taxes, etc., is doing well. But if we are to get to a 4.5% of GDP by the targeted date, which I think is 25, 26, then we need a little more than that. So plan maybe for more disinvestment proceeds, asset monetization, etc. That needs to be in place. I think the continued emphasis on expenditure switching to capex rather than revenue expenditures as a growth strategy. But I think there are critical areas of welfare like health and education that requires attention. So, to cut a long story short, I think we should actively temper expectations about the interim budget. There could be some announcements, but this is not the whole shebang. But I think I would be interested in the finance minister's speech as a broad guideline to what the government is thinking. And I think consolidation, quality of expenditure, and targeted welfare would be three major pillars of the long term vision or plan that she sets out.
Sure, meaningful one, sir. Noted your points. In fact, I will come back to you in specifically and discuss more about the capex plans and the welfare. We'll take your perspective there. But let me move to my other panelists. And Krishnan, sir, let me learn from you. What are your expectations?
Yeah, I hope I'm audible.
Yes, yes. Please go ahead, sir.
Yeah. As Mr. Abik was telling, basically this is a interim budget on account. So we cannot expect major policy announcements in this. Probably this will be followed in the regular budget, which may be in the month of July or so after the general elections.
Right.
Are you able to hear me?
Yes, yes. Please go ahead, sir. We can hear you.
There was some disturbance in this side. Okay. We cannot expect major policy announcements here. Having said that, I expect that the budget, the interim budget, which will be presented, will be keeping in pace the policy schemes which have already been announced for their continuity. That is what I expect. Now, if we look into what has happened in FY24, which is about to be completed, probably this is the first year after the pandemic, full 1 year. If you look into, there have been a lot of capex push, particularly on infrastructure, and I expect that this will also be continued in the FY25. That is what I expect. If I look into the BFSI sector, that too banking in specific, over the period, the entire banking financials have been strengthened, the balance sheets have been cleaned up, be it the public or private sector. We can look that the credit growth outpaces the deposits. This is despite the fact that the regulator has been increasing the benchmark rate continuously, moving towards northward, probably to fight with the inflation. But despite that, there has been a demand in the credit growth that indicates that there are good demand for the consumptions. When I say the consumption, naturally the manufacturing also will be going up. Now the government will be focusing, what I expect in the budget is that they may be focusing on continuing the existing schemes, as I already said. The capex will be the focus for them. And they will be looking for the consolidation of the fiscal deficit, bringing down to the estimated level by about 50 bips from what is expected to be in FY24. This is what broadly I expect as of now.
Okay. Yeah. Sure. Noted your points. We'll come back to you and maybe ask some specific questions. Tarun sir, can you please go ahead and tell your expectations specifically from the life insurance side?
See, I think I'm just going to be echoing whatever everybody else said. I think Ms. Sitaraman has been very clear that this will be nothing significant. It's just a vote on account. And we should expect the results coming out in terms of the fiscal deficit. There are certain expectations around it. Under 5.9%, I think if it remains, the market should be okay with that. And that is the expectation. But nothing spectacular. I think last year we are done with our spectacular announcements around taxation, which actually hit us negatively. and we're done with that. I think we can do with a not so spectacular budget as well now. I think that's eyes all open now for July, really, not for February.
Okay, sure. Manish sir, let me come to you.
Yeah, Amol. Always toughest to be the last one in an open-ended because you have to think of unique points. And while as a lender, let me hold on to the to my specific points for us
Right.
as as lenders, but maybe a few things that, and again, I'm taking the liberty of combining the February and July because directionally, what happens when notwithstanding over these two, among the things that I would love to see or we would love to see is, like Abhik mentioned and can speak much more to it. We understand there is limited room if we're going to come close to meeting our fiscal deficit
Hmm.
targets, which means that, all the heavy lifting cannot be done by the government via infra spends. So would love to see measures that go towards private capex picking up.
Right.
We've always understood anything beyond an 80% capacity utilization spurs that because the negative fallout of private capex not picking up, and we
Hmm.
saw the RBI coming down on changing the risk weights in what they felt is overheating on some of the consumer lending side. But that's a natural impact if you're in the business of taking deposits and lending, or you're in the lending business. You have to grow your balance sheet, and if industrial houses are not going to borrow, it ends up becoming a case of too much money chasing the same borrowers, and we've seen that in either yield compressions, basically mispricing risk, and therefore, one, we'd love to see measures that signal continuity and more specifically measures that spur private capex, such that credit growth is uniform and doesn't come down only to retail borrowers. The two areas that I will speak to more about both also happen to be our focus areas and are large engines of growth for us as a country and for revenues as well. One is
Hmm.
small businesses. Continuing to build on some of the partnership models the government has built, but to spur credit in small business,
Hmm.
and really double down on the housing for all. So
Hmm.
specifically around housing, double down on that objective. And there are a few things that I think we could do, both as an industry and help from government to, these are both key priority sectors. And a few thoughts on what we could ask for or expect from there that I'd be looking forward to in the next two budgets combined.
Absolutely. Thanks for sharing that. We'll certainly come back to you and be very specific also. Friends, those who are watching this show can also share their questions on any platform that you have joined, whether it's LinkedIn or any other social media platform, and you can share your questions. We'll try our best to take that question with the panelists here. Uh, so, Abhik sir, you gave an overview, giving economists' view and considering the current economy. My specific question to you is obviously it looks like the government will go for a fiscal consolidation or look at fiscal consolidation largely. They also have a target of 4.5%, for the next financial year 25-26. Uh, what approach do you think they will focus on more? Will they focus on growth or will they look at reducing the debt of the GDP and go slow on spending currently? Because the debt to GDP is also very high. And I think they have spent enough on infrastructure. Obviously, there is nothing enough, they will have to spend more. But given the current situation where they have to manage the fiscal and as well manage the capital expenses, what approach will they focus on largely, sir?
Look, I think if you see the reports brought out by the various credit rating agencies, the most recent one brought out by Fitch, what they are saying is that a 4.5% target is laudable, but you can't get there on the back of the current rate of revenue collection. Of course, the revenue collection rate has to pick up. But unless you have you can produce a joker on the back, you will have to compress expenditure in order to get to that 4.5% number. And I think fiscal depth is very important because, unfortunately, I think the frequency of shocks in the global economy, be it geopolitical, be it pandemics or whatever. I think the probability and risk of that has increased. So you need kind of fiscal space to fight that. You can't just fight it through monetary policy. So you need that buffer. So you, unless, and the joker in the pack happens to be money from sales of government assets. I'm talking about PSU disinvestment. I'm talking about monetization of assets. So that if you either we sort of have a very aggressive plan for that, or we will have to compress expenditures very carefully. I would sort of, advise against compressing, just blindly compressing revenue expenditures. There are a lot of welfare measure schemes that have done very well. Let me take the example of Water for All, Har Ghar Nal Se Jal. You have the Awas program, which Manish alluded to. These are very critical things that are that need to be there. We need more expenditure on health. So we will have to, if we have to prune our expenditures, we'll have to do it very judiciously. And to sort of bring the BFSI segment into this is that what is happening in order, with two things are happening with which the government is driving. One is formalization, either through the GST network or through the EPFO network. And then you also have an improvement in the standard of living of individuals and consequently their credit worthiness. So with a combination of more deft analytical tools, perhaps the credit market is broadening because of a combination of both formalization of small businesses as well as more disposable incomes in the hands of consumers. For instance, if you don't have to walk, say, 4 kilometers just to get your bucket of water in the morning, you save that much time to work. So all these sort of ultimately feeds into credit possibilities. It enhances credit worthiness, and I think that drive should be on. Some of it doesn't have a direct funding consequence, but I think it should be very much a part of the broader policy that the budget really encompasses.
I think that summarizes many aspects, and I think you put it really well. But let me pick up the point that has been come into this discussion and has been discussed on all forums at large. That in last couple of quarters, we have seen strongly growth with the public capex and not with the private capex. And let me head back to Mr. Krishnan. Being a banker, I'm sure he will have a realistic perspective here. So, when do you see private capex picking up, sir? What is that you are hearing from the corporates, whether it's mid-size or even the large corporates, and what is it that maybe government can also do? Because on their one part, pushing public capex, they have done their best and they're doing their best. But on the private capex, still, the cycle is very low. So, what is it that needs to be done on that side, sir?
Good, Mr. Amol. The government has been pushing for the capex, as you rightly said. As far as the public capex is concerned, it's on the full swing. The private capex yet to take the pace as expected. Now, what can be looked into and why the pace? When we can expect what are required support? The government has already started like a PLI, which is incentive for many of the people to come in. Likewise, today, if you look into the different states, the states also have started giving a lot of incentives for the private capex to be coming to their place. I expect that maybe in a year or two, I expect a good improvement in the private capex. We are seeing a lot of traction on this. I expect that the capacities will be going up once the large scale industries or a little bigger medium scale comes in. Then around that there will be number of MSMEs who will be there like mushrooms. That creates a lot of job opportunities, which will definitely help for improving the economy of the country. Basically, the MSMEs will be playing a major role If you look into the India MSMEs or the backbone, I can say probably next to the agriculture. So what is required is the private capex, what is required. Towards that, I expect that the government will be further dwelling upon to improve the private capex. The one which they have already done is the PLI in different sectors. I expect that much more will come. They will also be looking into some of the sectors which, due to various reasons, are having a tough time as to what can be given as relief measures. The government has been coming out with such relief measures. We saw in the past that when the pandemic came, they came out with a lot of relief measures. I expect similarly for some of the industries like textiles, which is facing a tough time now. I expect that some relief may be coming. With these things, I expect that the capex in the private sector will be increasing in the year.
Okay, okay. Noted your points, and let's hope that it increases, because then it will perhaps solve a lot of problems like job opportunities and all. Uh, Tarun sir, let me now come back to you and take it forward from where we started. Yes, last year there was quite a downward trend that we saw specifically for life insurance companies by government took a decision on the single premium side and all. But in last 1 year, sir, we have seen a very different rally. The mutual fund investments have gone up. It has reached to 50 million, 50 lakh crores of AUM, which simply shows that the bank's deposits are also shifting that side. Some of the take of the life insurance companies also been going to that side. Uh, so to boost the insurance penetration, because when we speak about life insurance companies, it's not just about life, but also about the pension and annuity products, which government also talks in their social security segment. So, considering the current situation, do you think that the government should now look at social security and perhaps boost products like pension and simultaneously life insurance aggressively?
See, Amol, we would be the happiest to have it happen. Uh, the trend, though, hasn't been in that direction. If
Right.
you just look at the fact that now we're moving to a new tax regime, where
Right.
personal taxation is basically taking up all the benefits and removing them. Basically, your ATC, ATCCC, all of these are now slowly going off. Uh, and there's a nudge towards going to the new tax regime.
Hmm.
But left on its own, I can tell you that whenever we've seen the industries doing very well, particularly the ones where there's a latent demand but not a top of tongue demand,
Hmm.
which usually are products like life insurance or insurance in general, which people don't want to, don't get up in the morning and say, look, I want to buy insurance, right? So you have
Exactly.
to, somebody really has to convince you. It's not your first thing in your mind. So usually long-term investments of this nature do require the help of the government. And whichever economy, if you look at, which has got higher penetration, usually has some tax benefits.
Hmm.
And we are seeing that in some places the government is supporting even now, despite the move towards a new tax regime. For example, and you kind of alluded to that, the pension
Hmm.
side. But the focus really is only the new pension scheme, the
Right.
NPS. What they've got to understand, maybe they do, but what we maybe need to help them understand a little bit more is that when somebody saves for the pension bucket, it is
Hmm.
not just the NPS. And we've got to look at various pension schemes that are in vogue today. And you talked about mutual funds doing well. Yes, it is a mode for saving, right? So there has to be for long-term saving, particularly when India above the age of 50 now is, let's say, bigger
Hmm.
population than the US today, right? When you're talking of such a large segment of population, also when you look at facts like people who are at the age of 60 would possibly be living longer post retirement and not earning anything longer than what they have spent in terms of life earning themselves. Hence, the pension side has to be a focus, and it cannot just all the benefits cannot just lie in one bucket. It's only when the as we always say, the animal forces start coming together, and
Right.
and all sectors start playing at it. that the accumulation of wealth will happen there. Hence, our request has always been that if we can be at par, particularly in the pension space, and there is a 50,000 rupee benefit that goes per individual on the NPS. The same should be made available for pension plans, for insurance schemes, for mutual funds as well. I mean, I have nothing against mutual funds also getting it. Then, if you look at the simple bit on annuities, Somal, I think what India suffers, or I can see that happening soon, is the risk of living longer is not talked about at all. And there's only one product which covers the longevity risk in the economy, which is the annuity product, where we take a risk on somebody's life and how somebody lives as long as one does. But if you compare the annuity, it's not as tax beneficial even as an FD. Today, when you put money in an FD, of course, it's your post-tax income that goes in, and it's only the interest that gets charged tax, right? While in the case of annuity, not only it's your post-tax money going into the initial premium, initial bucket, but the entire annuity in the hands of the recipient gets punished. So there's a tax there. It gets taxed as income there again. So there's a clear double taxation. And we've been making pleas to the government to maybe look at something in that direction. And that will really help pensions also to go up. The generic piece on life insurance is the fact that on GST today, we are charged an 18% for simple term life products.
Right.
Now, when you do want to promote insurance, then being at an 18% slab is rather too high. So you are paying 18% to the government instead of that money going to the underwriter and maybe cover the risk of dying early. So that has to also be looked at by the government. We are making requests to the government. Let's see what comes up in July. Hopefully, some benefits should come our way.
I think you highlighted a couple of points, Tarun sir. In fact, quite meaningful one and very realistic. The statement of risk of living longer, that disturbs all of us. In fact, when specifically there are less pension products with less returns available. Noted your points, Manish sir. Specifically, you partly touched that topic, but this is going to be an interesting segment that everybody is watching. The government has been pushing MSMEs and SMEs, but what is happening on the ground? What kind of changes, challenges that you are seeing in the SME, MSME finance space, and what is it that you need? According to you, the government should do now, to scale up this segment and take it to a next level, because we have been talking a lot about empowering and democratizing the finance for the SMEs and MSMEs. So, what needs to be done?
Yeah, well, look, for the last 25 years, we've always had the same opening line, which is it's an underserved, underpenetrated segment. And clearly the opportunities and challenges are much deeper than a simplistic 2-point list or a 3-point list. So for starters, not to belabor the point, but the rising tide that lifts all boats is either government capex or large industry spending. So it's been years that large corporations' balance sheets have been delivered. We look forward to capacity utilization, I beg your pardon, going up. And hopefully now it's a matter of time. Now, when that tide comes in, I think there are two broad opportunities. And let me break it up into facilitating MSME businesses growing. And secondly, making access to credit at better terms possible. So in the first bucket, there are areas, for example, we partner with the government e-marketplace, where the objective is to get MSME businesses to grow. Growing businesses are both fundable and need funding. It's a bit of a myth that there isn't enough access to credit. Every village in this country has a bank branch or a credit dispensation mechanism. It is access to timely credit at terms that work for everyone. So what can be done to help grow businesses? GEM is one such example, but Treads, ONDC picking up, and I'm looking forward to that happening. The second is there's enough of us in the private sector that are willing to pick up the mandate and move it forward, but may often need an extra layer of protection or help. For example, risk weights. One of the things that we would love to see happen is priority sector lending. The risk weights that we have to provide for are much higher on SME, MSME lending than it is on housing, for example. It's as much of a priority sector. If we brought the risk weights down, we can lend more, we can take more risk, and we can pass on some of these benefits to small businesses where often, again, like I said, it's not access to credit, it's just the terms of credit that don't work for me as a small business. If you're going to lend to me at 15 and the rate of return that I'm getting on my business is less than 15, it doesn't make any sense for me to borrow. So some of the work that we can do is on the risk weights. Another thing, just like SIDBI has CGT SME, I made this a pitch at Vibrant Gujarat, and we'll take it up with a few state governments, is can we look at select industries? And we're willing to pay the risk premiums, but to, in certain sectors, especially those that get hit by export downturns, keep the credit flowing. And, in return for a risk premium, maybe, insuring some of those loans, taking the risk weights down, essentially unleashes a higher order animal spirits in us as lenders that can keep the credit flowing. So that's a little bit on the credit flowing side to small businesses. I'll talk separately, if that's a better thing to do on, again, spurring on, and all of these have spin-off benefits on the housing side. But here are two examples. I would, ask for the risk weights to be taken down, on priority sector lending like SME, more partnerships to help grow MSME, SME businesses that then make need for credit, and specific industries by state that they'd like to see credit growing. And, us as the private sector coming in to extend, credit at better terms, is to look at opportunities to ensure some of these credits, not so much in the form of interest rate subsidies, but really almost like, we keep talking internally, between two lenders, you have a first loss guarantee. You can have one between the government and a lender. So these would be some instances that I would be outstanding to see in the course of the next couple of budgets, and just in general, after them as well.
I think we seem to have lost them all.
Right.
Manisha, I can supplement what you said about the risk weights, particularly for the priority sector. I feel that that may not be from the budget side.
Correct. It's not so much budget.
That cannot be from the budget side. It may be from the regulator. Basically, these risk weights, what we can request is that if you look into the Basel Accord, today what we have the risk weight is one size fits all. That is the standardized approach, right? We can move towards the IRB, internal rating based approach, for which the data becomes a challenge, particularly for legacy banks. But I expect that for NBFCs, that should not be a challenge. So we can take up with the regulator that can we go ahead for the IRB approach, where the risk weights can be based on. This will go a long way in, as you rightly said, having a lesser capital, which will reflect in a lower cost to the ultimate borrower. That is what I expect. The second can be, which the RBI has also said, about the co-lending. Today, if you look into the lending space, NBFCs are playing a major role. Excellent one they are playing. So NBFCs, the question comes on the resources. The cost of resources is higher than the banks. So one can accelerate the co-lending, which will help ultimately the borrowers, the consumers, to have a lesser cost of borrowing.
Abhik, you feel the gross debt shall remain the same?
Well, it should come down because we are at about a little over 80% of GDP, and we need to bring it close to about 65%. That's an acceptable limit for emerging markets. But what is, I mean, the consequence of having such a high level of debt? Let me sort of give you an example of that Fitch has cited that 25% of our revenue expenditure is going into interest payments. We just need to get that down. And I think when it comes to, I think to sort of take off from what Manish was saying, that for the smaller SME, so I see the SME sector as a sort of the big small companies which have, I think, come into the credit net in a fairly big way with reasonable pricing, both from banks and SMEs. And then you have the small companies, the true SMEs. And for that, I think, to take Manisha's point, we need backstops, right? And we need fiscal firepower to create these backstops. And I think the success of the CLGS is an endorsement of the thing that, with backstops, things do work for the SME sector. But we need, I think, greater, bigger backstops. And we have some kind of a playbook that has come out of the pandemic, a furlough scheme or whatever. I mean, you can tweak it to Indian conditions. But for all this, we need to have the fiscal depth and the ability to do it.
Sure.
So, and it shouldn't be
Thank you so
confined
much,
to really big
um,
crisis
Manish, and then
like.
Krishnan sir, and then Abhik. For first Manish sir, continuing with your points, and Krishnan sir adding. Uh, I think there is
We are
some issue with the
undaunted by
network
your
today.
absence, Amol. We are undaunted by your absence, and we continue to press our case for SMEs and greater private investments. So, I mean, that's the point that I was. I think everything, a lot of what we ask as banks or NBFCs really reduces it to a question of how much fiscal space we have. And I think
Hmm.
we need to create that fiscal space as soon as possible. And just another point that I'd make is, very happy that you're talking about the pensioner population, because as a bank, we started looking very seriously at the senior citizen pensioner population in terms of products, their needs, the fact that lifespans are increasing, simultaneously medical costs are increasing. So this entire piece, and where I think insurance is very, very critical, I think needs very, very serious policy attention. It shouldn't just be sort of confined to aging economies like Italy or China, for us to sort of wake up and see the problems. We need to sort of recognize it right from this stage.
So I'll just add to that, maybe, is the other piece, Abhik, that we're
Yes.
seeing is the missing middle, in the sense that there's at least a 30 to 40 crore population which gets paid between, let's say, 2 lakhs to per annum, or maybe 1.8 lakhs per annum, so 115,000 a month, to, let's say, about 50,000 a month. A lot of these people aren't able to get to the level where they will say that, look, they can save for insurance, while while you have the lots of people getting covered by the Jan Dhan Yojana, and of course the HNIs and upper middle saving for through mutual funds and life insurance. Uh, this is a missing middle, which kind of worries us a lot, where there is no appetite to take a product which is not right up there in your string of needs, and that gets to be a challenge. And how do we get these people to come in and say that, look, they would want to cover themselves the risks, and there are risks which is aplenty, right? There's enough of health,
Absolutely.
accidental,
Absolutely.
life cover risks. So all these are
Right.
needed, and they're essential for the growth of the economy.
Right. But
Sure.
I think so. And I think for both Tarun, you and Manish, I think the category right above, as far as retail lending is concerned, the category right above the BPL, so the below poverty line population is cared for in the government's own way, successfully, and so on. But there is a huge mass of population at the not really at the bottom, at the base of the pyramid, but close to the bottom, whose needs in terms of insurance, credit, etc., need to be looked at very, very carefully.
And in many ways, just borrowing from both of you and the, an equally important sector around housing, it's about moving the line. Exactly
Yes.
what Tarun was saying, that definitions change. So what
Hmm.
was considered, what 25,000 rupees a month means and what it translates into the kind of life you can live as a result. You may well have escaped poverty. You may well have gone into a different bucket. But this would be a great time, I think, Amol, as a recommendation, right, to relook at some of these lines or the limits that we place. So, for example,
Absolutely.
what used to be called affordable housing, or what used to be called economically weaker section, low income, higher income. So for instance, a house that costs 45 lakhs and below. Now, in the largest cities, uh, I don't think it's too much to ask to move the line upwards because it's very much a middle class home buyer, buying a 50, 60, 70 lakh rupee home that used to be considered luxury. And if you look at every indicator, right, that the high income will take care of themselves, as is currently being evidenced by passenger car sales, all of the luxury housing, all of that's on doing brilliantly. But the number of units that are selling on the lower scale really could do with a bunch of benefits there. ATC, for example, is still at 1.5 lakhs. Incomes have moved, house prices have changed. Interest rates, yes, they used to be at 9% for a home loan, but once you get used to 7%, it's very hard going back to 9%, even though it was 9% 5 years back. But when
Correct.
you've gone to 7 and then you have 9, suddenly the burden feels a lot. So the other side of this could be without incurring
Hmm.
greater expenses at the government level, because it would be a bit childish to have, government spend more as the answer to life's every problem. We can actually spend, many of us, all of us as institutions can spend, on the country's behalf, and, we'll be rewarded well. But just some of these things around definitions of incomes, definitions of asset prices,
Yeah.
PMEY, it's a big expectation. And I would imagine that, that's something that at some point in the course of this year will come back, so that just lending to someone buying a 30 or a 40 lakh rupee home just becomes so much easier for the
Hmm.
institution lending and for the borrower borrowing.
Sure. I think so. But thank you so much for continuing with the conversation. I think the god of network is not in support, and I think my expectation will be if the budget could, discuss also the network and in the IT infrastructure in the country. What the
But all
4G
this
and
is going to
5G.
happen in July. Nothing happens in February, right?
Don't, yeah, nothing in February.
Exactly. So, the network is an issue. Uh, but great. I'm really happy that, all of you continued. But, I partly heard. Uh, so, Abhik sir, I think we discussed pension, we discussed some welfare schemes. Quick question that I wanted to ask you, though you kind of supplemented. Does the government have the bandwidth now to spend on the welfare schemes when we look at the, the people specifically from the BPL, and various aspects, whether the health or the education or something like that?
Well, I mean, a simple answer to that is that with your debt at over your public debt at over 80% of GDP, it limits your bandwidth, and that's what we are presumably trying to do is to sort of, and what it does is sort of create such a huge interest bill that you're
Hmm.
busy paying that with your receipts rather than spending it on welfare schemes, so and so forth. So one correction has to come. We need to get into a sustainably lower level of public debt, and then a lot of things will follow. But we must be careful that in order to try to get to this level, which is comfortable and sustainable, which gives us fiscal capacity to do a whole bunch of things, we don't end up, cutting the wrong expenditures. And let me just be a little contrarian here. I think there's a bit of a capital spending fetish in our country these days.
Right.
Everything that is deemed investment or capital spending is supposed to be good. Anything that is labeled revenue is not good. I mean, maybe from a broad macro perspective, yes. I mean, they have higher multipliers, capital expenditures of higher multipliers, and so forth. But for an economy like India, and for those of us in this group who are trying to address the base of the pyramid and the tiers right above the base, I think welfare schemes, which happen to be under revenue heads, are very, very important. And I just hope that in the process of consolidation, we don't, cut back on some of these very critical programs. I'm sure the government is aware of this,
Right.
and that's the only thing I can offer.
Yeah, true. Uh, so Krishnarson, broadly, we discussed about private capex, SME, MSME, the welfare schemes, the fiscal consolidation. But there is one common question which largely at the common man or the missing middle or the middle class has is whether the home loan or the auto loan will get cheaper. Though the RBI has not increased the repo rate in last couple of months, it's not that the rates are cheaper. In fact, it gone up significantly before RBI took a pause. Going ahead, I know this is not going to be a budgetary question, but the kind of capital that the government has infused, the kind of private investments that we are expecting, do you see, do you foresee that the interest rates will also come down going ahead? Or you think the current situation is such that maybe the capital expenditure will take some time, or the tempo will continue and people will have to still, pay more, or maybe continue with the same EMI that they are paying now?
Yeah, it's a good question. As you were telling that we have been seeing the raising interest rate continuously for quite some time now. Of course, it is not only in India, across the globe, different countries we have been seeing. I expect that this may continue for a little more time before it starts coming down. As far as India is concerned, the RBI has been putting a pause for few quarters. They are not increased. They have put a pause. But I expect that by maybe end of 24, the rates will start coming down. That is my expectation. Till such time, it may continue at the same rate. That is what I feel. But if we look into, yes, the cost of lending has gone up because of that, because of the rate transmission. But we should also look into, is there a demand? As I was telling, yes, there is a demand, but the profit margins of the business enterprises will get thin because of this. So I expect that this may be offset by some taxes. For example, if you look into very recently, in addition to the interest rate, the Reserve Bank also increased the risk weight on the consumer credit.
Exactly.
Now I expect that to keep the same pace of the consumer spending. I expect that the budget may come with some shock to the taxpayers. I expect that there may be a marginal increase in the standard deduction. That is what I expect in this budget. So this will help for the period till, yes, we see that the interest rate again see the southward trend. There will be a reduction in the interest rate.
Okay, let's hope that we noted that. There are a couple of questions. I think few of them we already answered, but there is one specific question about the pension, which Tarun sir, I want you to take. The viewer asks, not necessarily in the interim budget, but can the industry expect tax breaks for NPS contributions to boost retirement savings going ahead? Maybe not in this budget, if next budget possible.
See, so my bit on that is today there is two benefits that the NPS scheme gets. One is which lots of people actually not aware, but this is a good medium to kind of send the message across, is that if your employer is from your CTC, contributing to your pension now through and to the NPS plan, that's a tier one, that is what is called, then up to 10% of your basic is available as a tax break. It is not taxed. And that by itself is a significant bit. I don't think many corporates have been able to communicate that in detail. and I think communication around that becomes kind of a bottleneck today. And if employees were to figure that out, it'll help. The other bit is as an individual too, you can save up to 50,000 rupees into an NPS scheme, and that is tax free. So I think these are two significant bits. The requirement of the day, Amol, if you ask me, is on the pension side to increase the number of products which get similar benefits.
Right.
I think both these have to be communicated. I think the way the Prime Minister had put in the Jan Dhan Yojana and the Pradhan Mantri PMJJBY basically came in, and it was 2 lakhs of benefit term cover for every uh, individual who had a bank account. I think that made a big difference. So some bit of maybe I don't know whether the government can mandate or if nothing else push this and let these two facets be known. I think that individually should make a big difference. So there needs to be a platform where this information can transmit across the industry, and other products be included in this kind of an ambit as well. I think those are the things that will widen and deepen, if you may, the real, the pension money flows.
Okay, noted your points, Tarun sir. Just one more question on the tax bracket side. Though there have been lot of suggestions and some options given to the people at large, specifically on the taxation side, the basic bracket almost remains the same. So going ahead, do you think that the government should specifically consider the basic bracket needs to be lifted? Maybe Tarun sir and or be Abhik sir, you can also add. Basic as in, I think 2.5 lakh rupees is the exemption limit, which I think is the we were talking about. Anyone wants to quickly add about it?
So maybe I'll just step in, and I think Manish kind of alluded to that.
Yes.
That it is the time has come for the government to look at what is BPL, what is below poverty, what is the missing middle, what is an upper class, and so on and so forth.
Yes.
They did give some tax benefits for people upwards on the highermost tax bracket where the surcharges were reduced. But having said that, I think it's the missing middle which needs the benefit more right now. And that is where the government should relook at either reintroducing ATC, ADCCC, and more benefits there. But maybe I don't expect that to happen because they're nudging everybody towards the new tax regime. But in which case, then they should, kind of the exemption rates, exemption baselines have to go up.
Manish or Abhik, you want to quickly add on that?
Certainly, I think there should be a basic indexation to inflation, and inflation has been going up quite a while. So nothing stays constant. So you'll have to see what the brackets actually amount to in terms of real purchasing power, and make adequate in whatever classification you're doing on the basis of income. What 25,000 could buy 10 years ago is very different from what it can buy today. And that this also happens at a more frequent pace from year to year. So that's for sort of a fundamental baseline recognition that you need to make, and make the changes accordingly. And so a lot of classifications, a lot of exemption thresholds, etc., will come under, and categories to which you are selling or delivering a product will get redefined in the process. It's about time we did it, because
Right.
and I think that one of the biggest mistakes that a lot of companies that came in the early 90s, I remember there was this great euphoria about the great Indian middle class, and everyone thought the great Indian middle class was very similar to the US middle class. But the great Indian middle class actually starts at a very, very low income level, and that income level again has changed. So that's. So we need constant recognition and revision of these things.
Sure. I think that's it from my end. I wish I could have taken more questions, but I think many of them we have already answered, and a few questions from the viewers were a little repetitive also. But yeah, many of them want some exemptions in the tax slabs, is what I can see. That is one common question. But thank you so much, Krishna sir, Tarun sir, and
I think we have a problem with the network again.
going to be a
Yes.
Yeah.
vote on account.
I think a budget benefit around network is a good idea, actually.
Yes.
And sharing
Right.
your
Thank you. Thanks, Amol. Thank you.
Thank you.
Thank you
meaningful
very much.
thoughts
Yeah.
at
Thanks.
ETBFSI.com. Thank you so
Meeting
much.
on you.
Yeah.
Thank you.
Thanks.
Thanks,
Thanks, everybody.
everybody.
Krishnan,
Thanks.
Manish, Abhik. Thank you.